Welcome back. We're in the component section 5 of chapter 8, and we're going to talk a few minutes about the concept of stickiness, especially when it comes to wages and prices. And typically what happens in that, when we were talking earlier about the short run aggregate supply curve, what happens is when you're in that situation, the economy can perform above potential, especially potential output in the short run, and it's driven by the nominal wages are slow to adjust. That's the way that it shifts from. So there's a shift in aggregate demand. It pops that thing out, and there's a new equilibrium point, and that new equilibrium point, it takes it a while for everything to get to that new equilibrium point. And it is because that, as we've said in the past, wages and prices are slow to respond. And one reason that wages are sticky, if you just stop and think about it, labor contracts, nominal wage rate is for the most part fixed across a potential time horizon. If I think about when I worked in the healthcare environment and I was employed, and let's just say Blue Cross Blue Shield, my annual salary was fixed. In January, usually it occurred in the February, March timeline. Then it kind of corresponded with the tax year, and you would get a letter from your immediate supervisor, and they'd say, congratulations, you're going to be paid a bonus, and at the same time, you're also getting this letter that says, and this year would have been 2023, so sometime in early 2023, they would say that your salary for 2023 has increased 2% or increased 3%. And then that would set your new salary for 2023, and it would set it for a year. And you would get your salary adjusted again in 2024. And that's the way it works with individuals, especially in a corporate environment. It works for the most part with professors in universities. They're on yearly contracts and annual contracts, and it may be a 12-month annual contract, and they may be paid, that 12 months payment may be spread out over 9 months because they typically take off the summer months to do research and try to get publications out the door, but they're still on an annual salary. If I think about union contracts, a lot of union contracts, at least the ones that I've dealt with in the past, are usually a 3-year time horizon with and typically wage adjustments tied to the CPI, but the COLA, the cost of living adjustment, again, it takes effect on the annual date of the contract. And let's say it says, in year 1 you get a 2% increase, in year 2 you get a 1.5%, in year 3 you may get 3% increase, and those are negotiated during the collective bargaining negotiation process, and they are set based on not only the union's view but the employer that they are negotiating this contract with. It's set on their view of the potential cost of living, the potential change in the CPI, or whatever metric that they agree upon to use to adjust salaries kind of over the life of the contract. And people ask, well, why would an employee, or why would an employer negotiate a 3-year contract and base it on an increase on an annual basis when the future is uncertain? And one reason is negotiation. It's extremely costly to negotiate. You're pulling people out of production. You're pulling people away from administrative duties. You're losing productivity because they're having to stop and work on this negotiation, and the negotiation process takes forever. Information change, can get adversarial, can lose, can use, end up with strikes or walk-offs, or in the news now, they're talking about, I guess, the writers and the actors unions, and, in California, getting ready to go on strike. Saw something, came across the news feed the other day that UPS, I think, if they don't have a new contract with July 31st, they're going to go on strike. Strikes are costly, disruptive, not good for society. So individuals will negotiate these longer contracts. And it helps if you're an employer, it helps to budget, and it helps to understand, again, your factors of production, that labor factor of production. It helps you forecast in that budget for that factor of production going out over a time horizon. If you're an employee, a lot of employees just like to know what their paycheck's going to look like, at least from the gross income side of the paycheck. It's going to look like over the next 2 to 3 years. Cost of living adjustments, they're risky on both sides of the house, but especially risky to producers because of volatile pricing, especially on the inputs. Think about if you were a producer and you had negotiated a contract in 2021, right when inflation started blowing through the roof, and you had that thing locked in for 21, 22, and 23. Think of what it would have done to your profit margins if you had negotiated some long-term contracts and had expected that the price of your product was going to increase at a rate of inflation, and you're talking about all the inputs of production. You thought you had those locked in, but you didn't, and all of a sudden, think what that does to your profits. So, and if you think about just the impact, and I can actually go back to my days in Buffalo working for Blue Cross Blue Shield. Buffalo, the market in Buffalo, most individuals, at least that worked for me, had grown up in a 2-income household, and usually their father and mother belonged to a union. That's just the way the environment was in Buffalo, and a lot of people were focused on. They'd grown up in a union household that generated, the family's income, and for them to go to a job that was not unionized, it was sometimes, in some cases, a rude awakening for them. So if that's the culture you're expecting, and especially they talk about in the book from the institutional side, if that's the culture you were expecting, and it is really difficult to go to a situation where you're not used to having a 3, 4, 5-year contract, knowing what your nominal wage is going to be and nominal income is going to be, and then all of a sudden you're going to an annual contract. It's a little disconcerting for them. And what you find with employers, it is really an exceptional experience. If an employee, it's really out of the ordinary for an employer to go out there and lower wages. It's just easier to lay people off than to lower wages. And then you've got things like, as we talked earlier, that was in, I can't remember what chapter it was, but when we were talking about price ceilings and price floors, think about the price floor. What's a minimum wage? It's the price floor. And you set that minimum wage above, what we say, you set that minimum wage above the equilibrium wage rate, and you have to, because it won't be effective any other way. So, you've got the institutions that are setting these price floors. So that's going to make, what do you think that does to wages? That makes wages almost impossible. They're not just sticky at that point. When you set a price floor, those things are locked. They're not going to move. It makes it really difficult, especially with wages being sticky, when you've got institutions, and when I talk about institutions, I'm talking about mostly federal and state government, maybe even local government institutions that are setting these price floors, trying to, and it just it locks in. I mean, it is just not, it's not sticky anymore. It is like almost, it is inflexible at that point. So it makes things really difficult for wages to adjust to get us from that short run aggregate cost back to the long run aggregate cost. And then if you talk about, so you've talked about the wages, and it's a similar concept on prices. So you go back to your factors of production again: labor, capital, natural resources. Not, those big three are really, in fact, impacted by price. And a lot of factors of production are locked in, as do a lot of the employers lock in the prices of the products they sell. So, if prices are slow to adjust, it's going to make it extremely difficult for those markets in the long run to get back to equilibrium. And wage stickiness actually could lead to price stickiness, again, depending on how those factors of production are negotiated and what kind of contracts they are. And actually, I was just going through my notes, making sure I didn't say anything that was incorrect. But with wages locked in, especially with union contracts, some companies are kind of a wait and see, that they may not adjust the prices of their output. They may wait and kind of see what the economy does. They're employers and producers, when inflation was rampant in 21 and 22, especially in 22, they may have been taking this wait and see approach to see if things started, because you had the Feds increasing interest rates. They were maybe a wait and see position to see what the economy was going to do before they decided to change the prices of their products. And so they talk about in the text, they talk about menu cost, and we also kind of touched on the concept of menu cost in one of the earlier chapters. But you have outfits like Land's End, LL Bean, some restaurants, and it's it is expensive to change public prices, and there's a cost to doing that, and it upsets customers. And a lot of these companies will kind of take a wait and see attitude about the prices of the products, to hopefully that the economy will adjust itself and make things smoother or make things more stable in the future. And it is just, they try to forego the price changes, and that's what they talk about menu cost. I think in the example they gave in the text, it was a restaurant that had a multitude of different dishes on the menu, and they were talking about just the cost of change and how frequently they would change it to keep up to high price levels, high inflation rates within a given timeline. And you do have some companies that may change their prices on an annual basis, and if they change them on an annual basis, customers kind of get used to that. We were in the process of remodeling a kitchen. We started in December, and we knew, we talked to different appliance manufacturers and warehouses, and we knew that there was going to be a change in price. Didn't know what the level of change was going to be, but we knew there was going to be a change in price come January the 1st. But we still couldn't collect enough information to make a purchase at that point. But we knew, because they just changed and updated pricing January the 1st of every year, and we knew that going in, and we'd had experience with it in the past, and we should have collected our information a little quicker, but we just didn't get around to it. And then the one, and it's come up in a couple of different classes. They talk about menu costing. If you think about your local gas station, you can change those prices. The price at the pump, I mean, that's pretty easy to change. What you have, and a lot of my experiences I've said in the past, is in the healthcare environment. And what you'll have on the provider side of the house, they have a mechanism within their billing office, and it's called a charge master. And they have, with each code that they bill, they have a certain price that they're going to bill. Either you as a private payer, if you don't have any health insurance and you're paying out of pocket, or they may be charging CMS for Medicare, Medicaid, or they may be charging Blue Cross Blue Shield Tennessee or United or any of your big players. They have contracts in place, and they can adjust their prices multiple times in a year by updating the bill charge that they bill to you or your health plan, and what they call the charge master. And unless it's written into the contract with, say, the health plan, that they can only update that charge master X number of times a year, they can update it as many times as they want to during the year. It doesn't a lot of times impact a contract with a health plan, unless it's a contract that the health plan's paying services based on bill charges, because typically your healthcare contract between the health plan and the employer, or the health plan and the provider group, is going to be based on a fee schedule that's fixed for a year, or some kind of a prospective payment system that they know for a normal vaginal delivery, or an orthopedic service, or a knee replacement, or the heart valve replacement. They have it negotiated in the contract so that not only the provider knows what they're going to receive, but the health plan knows what they're going to pay. So that's the way that's worked on that menu. And everybody knows that unless they have a contract that has an escalator clause built in it, they know that there's going to be a negotiation, typically in Q4 of a year, and that negotiation will negotiate new prices between the health plan and the provider, and the healthcare provider, that take effect on January the 1st of the subsequent year. So that's the way healthcare works, and that's the way that you're looking at menu cost and sticky prices in a healthcare environment. And then you talk about, when you're talking about from a producer's perspective, you've got long-term contracts on your inputs. So let's just take King Arthur Flour. They're making flour, they're making cornmeal, and they are locking in the prices for flour or corn, or they're locking in the prices for wheat that is a input into the flour, into the making of flour, or corn into the making of cornmeal, and they're either locking them in with dealers or distributors, or they're using futures and options markets through the Chicago Board of Trade, the Chicago Mercantile Exchange, to help with the futures to offset those spot prices. So if they've got prices locked in on the futures and options markets, and even if the prices go up, they don't have as much financial risk exposure. Same thing is one of the first job offers I received out of graduate school was to go to work for Burger King. And the responsibility was going to be pricing or locking in the price of the beef that they use to make hamburgers. You see it a lot. And so you're talking about menu costs, you're talking about long-term contracts. You can look at institutions, their laws, customs, regulations that cause prices to be stickier or more inflexible than they could be. Think of in one of the previous chapters, again, we were talking about price ceilings and price floors, locking prices in. Local electricity, local electrical cooperative, local gas company, they are locking prices in, and with these long-term contracts, it makes prices on that side of the house, it makes them really sticky. It makes them really difficult for them to move and adjust. And because of that, it makes the long run average demand, and I'm sorry, the aggregate demand curve and the long run aggregate supply curve, once they move away from equilibrium, it makes it difficult for those two to get the economy back to equilibrium. That's the beauty of that short run aggregate supply. It helps macro economists work through the adjustments and to explain how those adjustments work and to predict through their models what are the impacts of those adjustments going to be. And they gave some examples in the text about, changes in government purchases and, changes in healthcare. And really on changes in healthcare, it was interesting because they get into if healthcare costs increase, that increases the cost of the factors of production, and it's going to increase the cost of the actual production process, and it's going to eat into profits. One thing that they didn't get into, and in the text, is if you're a health plan and you're selling benefit plans or coverage to a employer group, it's either fully insured and for a premium amount, the health plan will sell a business, a benefit package to the employer group and all of their employees, and it's monthly premium that the employer group pays, and that premium set. So it's usually negotiated once a year, so it's set. And if healthcare prices, if the cost of healthcare prices increase and it's costing the health plan more money, it's not like they can go back out and negotiate that premium with that employer group until the next time for that contract to come around. And you look at the flip side of that, and it's what they call an ASO. It's a self-insured employer group who has decided that they will pay the health plan an administrative cost to develop a network, process claims, make sure medical management's in place, look for fraud, waste, and abuse. All of that kind of rolled into an administrative cost. And they've decided that they're going to incentivize their employees to take better care of themselves and try to control healthcare costs that way. So it's just a little different spin on what they're talking about in the textbook about healthcare cost and increasing. It does increase the cost of production, but there are mechanisms in place that an employer group can get around that and not have hardly as much risk exposure. One thing a lot of employer groups are moving to, and I don't know what the benefit package is at, in certain, companies, but there's a mechanism now called a high deductible health plan, in which a lot of the financial risk for healthcare costs is being transferred back to the individual or back to the employee, and it makes the employee responsible for a bigger chunk of their healthcare costs. And it's one way that employer groups are trying to control the cost of production, is to try to move, so trying to offset or trying to transfer some of that financial risk for healthcare costs and healthcare price increases, trying to transfer it back to the employees. So just kind of a little aside to try to tie some of that together with what they talked about in the textbook. And that brings us to kind of a stopping point. I wanted to go through the wage and price stickiness almost to its own section, because I wanted to spend maybe a little more time than necessary talking about it, because the fact that wages and prices are sticky, that they are somewhat slow to move in response to some kind of a change to the economy, that's what inhibits the equilibrium changes when you're trying to get aggregate demand and long-run aggregate supply to move to another equilibrium point. So hopefully that simplifies it some. If not, there'll be some comments that you can respond in the comments section of this video, and I'll try to get back to you. But that's going to wind the portion of stickiness up for right now. And I think I've got probably one more section to go through, and we'll kind of wind up chapter 8. Talk to you soon.